Bracing for the second wave, an economic outlook on Southern Europe, Turkey, and Middle East. Hello, everyone, and welcome to today's webinar. I will be your moderator. My name is Antonella Vona, and I am the Region External Communication. I am glad to see many participants today, and we are glad as Coface to support you with an economic update in this unprecedented economic condition. So thank you for joining us. I'm pleased today to introduce our speaker. Before I hand the mic, I would like to tell you that a recorded version of this webinar will be available. We will have at the end of the presentation a Q&A session. So you can submit in every time any question that you would like to address via the question window. So please feel free to send it through the system, and without any further out, I give the floor to Marcos Carias for his presentation. Thank you.
Thank you very much, Antonella, and thanks everyone for joining in. So it's probably best to start with a little update on what's going on with the pandemic. So in many parts of Western Europe, France and Spain notably, daily confirmed cases are larger now than during the first wave of the pandemic. Now, we should take into account that during the first wave, during the lockdown in Q2, what we were detecting was just the tip of the iceberg. True numbers were probably as much as 10, 15, 20 times higher. Nonetheless, there are also worrying signs that the rate of positive testing is coming in higher, that hospital occupancy rates are beginning to rise and reaching significant levels. And so in reaction to this, governments are imposing gradually stronger and stronger forms of partial lockdown. So, for instance, in Madrid, which is right now the epicenter, the European epicenter of the pandemic, we are seeing restrictions on mobility, on whether you can or can't leave the region without some kind of justification like work or health reasons. We are seeing bars, restaurants, and businesses, shops seeing their capacity limits reduced to 50%. Similar things are going on in Paris and in parts of France. So the second wave is a reality, though these partial lockdowns will be a lot less disruptive than what we saw during Q2. It is reasonable to assume that they will have true economic effects. The situation is a little bit better in Italy and Germany, but we need to monitor the situation constantly because it is likely that these numbers can go up at any moment. So regarding our latest revisions to our growth forecast, we have been revising them for the case of Europe a little bit to show weaker contractions, slightly weaker contractions than what we were forecasting earlier this year, mainly because in Q3 during the summer, the recovery is showing to be a little bit stronger than what we were originally anticipating. Nonetheless, there is still possibility that later in the year, the risks are tilted to the downside. There is still the possibility that we will have to do a further revision, most likely downwards, once we start measuring how strong the effects of the second wave are. Again, when it comes to growth forecast, what happens earlier in the year is more important for the final number than what happens later in the year. So right now we are looking at these contractions around 11, 12% for most major European economies, a little bit less for Germany, who saw a better performance during the first wave. So one of the reasons why we are anticipating a relatively good performance in Q3 is what we can know from high frequency indicators. So for instance, we have this Citymapper mobility index. Citymapper is the app that many people use to navigate major European cities, and they tell us a lot about how much people are moving around the city. And this is in general a good proxy for the economic activity, especially in terms of retail or services that is going on in the city. And what we see is that in many northern European cities, we were back to normal levels during the summer, um, which is also the case in Paris, and a little bit less the case, even though there was a significant recovery for southern European cities. So if we look at Italian cities, we peaked recently at around 70% of normal activity. For the case of the Spanish cities, a little bit less, more around 60%. But on the negative side, we are seeing the early signs that the restrictions are starting to take hold. We see a little bit of the beginning of a trend reversal, but nonetheless, the hit, the impact of these restrictions seems to be nowhere near as acute, at least as of yet, as what we saw during the first lockdown, at least in terms of mobility. Looking at the hard economic indicators, the hard economic monthly indicators, what we are seeing, even as of the midsummer, June, July, is that in our major southern European economies, we are already seeing the start of a trend reversal. For instance, when we look at retail sales, we see this relatively homogeneous evolution with, for instance, France, of the year-on-year growth rate of retail sales up until June, July, where it looked like everybody was going into positive growth territory, and Spain and Italy were almost there, but peaked at a level slightly below what we were seeing in 2019, and it is likely, from what we see, for instance, from credit card transaction data, that we are going to stay in these levels for August and September, and most likely when the lockdowns intensify, especially in Spain, that this will start contracting again. On the side of manufacturing, the latest data shows that the recovery is still in place. Now, again, manufacturing production, they are trying to make up for the lost time when they couldn't produce when firms couldn't produce during the lockdown. In some sectors, there are backlogs in orders, etc. And also a sector that is more dependent on exports than services or retail. Nonetheless, we should expect the effects on demand to start slowing down manufacturing production at some point later in the year. So where we are seeing clearer signs that the second contraction of the year is taking place is in the soft indicators, in the confidence indicators, particularly on the consumer demand side, on the services side, and particularly for Spain, which is where things got worse earlier, and therefore, which can possibly the country that can possibly be, what is announcing the conditions for the rest of Europe. So we already see consumer confidence, which, as we know, is an early indicator of the consumption that will take place in the later month, reversing quite clearly starting in August. And this is also the case for what's happening on the side of the businesses and in services, which, as we know, is a sector of the economy that is most vulnerable to the pandemic and the associated restrictions. So given what has happened during the year, and given what is looking, all these bad developments that are looking to happen in the end of this year, one big question to which we have been confronted is what is going on with insolvencies, with business insolvencies. So normally, in regular times, intuition would tell you that when GDP contracts by this much, you should expect companies to suffer, and you should start seeing company insolvencies pick up. What is being told by the data is exactly the opposite. So, for instance, if we look at the figures that are published by the Spanish Institute of Statistics, the INE, we see that company insolvencies in 2020 are actually around 40% down with compared to 2019 levels. We see a similar picture in Italy, and we see a similar picture pretty much all across Europe. The only places where we're starting seeing insolvencies kick in is in the Scandinavian countries. So what is going on? Naturally, the principal factor here are all the exceptional measures, all the interventions that are being carried out by the state, by governments, extraordinary fiscal spending, extraordinary monetary easing, and in particular, these extraordinary measures that are especially targeted towards companies. Now, there are some of these measures that we will be talking about later that we have reason to believe are actually protecting firms, are actually potentially avoiding insolvencies because they translate into positive cash flow, extra cash flow for the company. We are talking here about measures like furlough, which are the temporary work reduction schemes, ERTES in Spain, Cassa Integrazione in Italy, but also guaranteed loans. But there are also other kinds of measures, specifically temporary modifications to insolvency procedures, to legal procedures that have been taking place in all the European countries that more or less, for a time being, either suspend the obligation to file for insolvency in case of payment default, or for the case of Italy, for instance, made the insolvency applications actually irreceivable by the courts up until July 31st. So these are merely bureaucratic measures that are likely to be resulting in a delay of the insolvencies. But we have reason to believe that these might come at some point, either at the end of Q4 or in the beginning of 2021, that we might start seeing these show up, especially earlier in Italy and France, where many of these restrictions have already expired. So the other element that I was talking about is that actually it is true that the governments are doing very exceptional things to protect the productive apparatus, very exceptional things in their own words to put the economy into a halt and give life support to companies. Possibly the most significant of these are these furlough schemes that, as we can see by the data on the graph to the left, have been very, very thoroughly used by many sectors in the economy, by the most affected sectors in the economy. So most notably hospitality, tourism, where, for instance, in Spain, after 50% of the workforce was concerned at the highest point of the lockdown, according to the Eurostat data, but have continued to be used, even though to a lesser extent, during the better months of the summer months. And in Spain, for instance, the possibility of acting on this measure has been extended recently, last week, and actually the level of protection in many cases has been increased. So this is something that concerns all companies that see a significant reduction in their turnover, in their activity, and that therefore the effect of this, by allowing companies to adjust their level of desired work very flexibly, is helping their profitability and therefore their cash flow generation and cushioning the blow to turnover. Another important measure is guaranteed loans. So we saw earlier in this year these very large envelopes of funds that were made available to by governments, double-digit numbers in terms of GDP. A much lesser amount of these loans have actually been granted to companies, but this is nonetheless, especially due to the very targeted nature of these loans, quite possibly having a significant effect of the liquidity of the weakest firms that this can be granted to. So suppressing payment delays, suppressing insolvencies in many cases. It should be noted that these loans in principle are attributed to firms that that were considered before the pandemic to be in relatively better financial health, not like the furlough, which is attributed a lot more liberally. So these are measures, as I mentioned, that we suspect are having a real effect in the suppression of insolvencies. So when we examine what is going on at the sector level, there are basically, and these are the risk assessments that you will find in our Q3 barometer. I would say that there are three kinds of sectors, three reasons why a sector would worry us. The first, quite intuitively, is the level of exposure that the sector has to the lockdown restrictions. How much a lockdown affects the activity of a sector greatly varies. As I mentioned earlier, services particularly exposed, particularly services like tourism-related activities that need mobility, like transport that needs mobility, passenger transport particularly, but also retail, which depends a lot on consumers actually going to stores to buy things, bearing apart e-commerce, of course. We're also very worried about industrial sectors that, for structural reasons, had already been experiencing difficult years even before the pandemic. So automotive, metals, these are all sectors that, on top of what's going on with the pandemic, are seeing tougher environmental restrictions, are dealing with overcapacity issues, and that we're seeing these structural difficulties already wearing down on them, and that saw a strong contraction in activity also related to COVID-19. And finally, something that for the purposes of forecasting insolvencies is very important is sector structure. What I mean by this is the relative prevalence of small vulnerable firms in the sector. So when we look at insolvency statistics, what we always see is that there are a couple of sectors, because there are a lot of small firms always in these sectors that account for a large share of insolvencies. I'm thinking about retail, I'm thinking about construction, and thinking about textiles, where what you see typically is a couple of dominant players, larger companies that, despite the fact that they're in trouble, manage to get resilience, manage to get support from banks, etc. And on the other side, many small companies that don't have the buffers, don't have the resilience capacity to survive in an unfavorable environment. And this is again where we have every reason to suspect that the lion's share of insolvencies will come from. So looking at what's going on, when we see what's been going on with activity this year, what's been going on at the level of the balance sheet, what were the conditions of the balance sheet before going into COVID-19. What you have on this graph to the left is the reduction in activity that we saw during the first half of 2020 for different sectors. And I compare it to what we had in the first half of 2009. And my objective here is to see which sectors are seeing something similar to what we had back then, which sectors are seeing a situation that is actually maybe not quite as bad as what we had in the last crisis, and for which sectors is worse. So very obviously, air transport accommodation, it's day and night. What's going on right now in terms of activity is just catastrophic, even when compared to what we had back then. But I also see that we had some sectors that right now are actually doing a little bit, at least in terms of activity, not as bad as what we had during the last crisis. This doesn't mean that it's a good situation, but if you look at automotive, for instance, we had that really violent, really acute contraction during the lockdown, and then a little bit of a rebound. Whereas what we had during the last crisis was a very prolonged, very stable contraction. And actually, for the automotive sector in Spain, what we had during the first months of 2009 was on the average worse than what we had so far. When we look, however, at the balance sheet, what you have here is a solvency ratio here on the right, the gross operating profit to net debt ratio. And what we notice is that there are sectors, when I compare to what was going on in the year where insolvencies were at the highest point. So in many cases, this is 2013, 2012. We saw a very negative situation back then in the balance sheet because it was coming after many years of balance sheet degradation. But still, what is worrying is that there are sectors like retail or construction that the weakest firms in the firm population have a very weak profitability, not a lot of margin. Even when helped by what's going on in furlough or guaranteed loans, it is likely that we will see at some point or another a lot of insolvencies coming from here. Textiles, that is in a very prolonged crisis, that has been losing market share globally, competitiveness, and accommodation, which are not high margin enterprises. On the other hand, we have other manufacturing sectors like chemicals, which are in a better position, and another sector that is cause for worry is oil refining, which is of course suffering the effects of this shock to oil prices this year, on top of what we had all the years since 2014. So also a sector to look out for. Situation is similar in Italy now, except maybe when you look at these at this balance sheet, at this profitability ratios. Main difference is that during the worst year of their insolvencies, the profitability ratio, this green bar here, was a little bit better for Italy, and this is the reason. The reason for this is that the last crisis in Italy was a little bit less acute. Than what it was in Spain. Still, same picture, especially worried about retail or construction sectors where weak firms have low profitability. Air transport, of course, notoriously unprofitable sector in Italy, but here there are some particular cases of state support. So to conclude, I will just talk a little bit about political risk, which is the subject of a barometer article. And this is somewhere where we have relatively heterogeneous developments. So Spain and Italy, obviously two countries characterized by their political fragmentation, but that have seen a different evolution during the pandemic. We have seen the government actually become stronger and more legitimate in Italy, where there is a better perception of satisfaction with their handling of COVID-19. Whereas in Spain, the frictions between regional governments and national governments have become much more tangible, and we will have to see how this translates and how these tensions translate into the management of the investment of European funds, general economic management more generally, which is a risk that might weigh down in 2021. With this, I finish my presentation and I leave the floor to Seltem.
Yes, hi. So thank you for joining in. I will start my presentation with the Middle East and then continue with Israel and Turkey. So regarding COVID-19, we see that the lockdowns across the region are now eased, but not totally. Regarding the COVID-19 cases, there is some updated data, as you can see in the first graph. Well, most countries have been able to reduce the number of cases down compared with March and May period, except for Iran, as you can see. But these of restrictions and the summertime intra-country travels have resulted in a renewed increase in the number of cases. On the right-hand side chart, when we look to the stringency index, which records the strictness of lockdown style of the government policies that can change people's behavior, we see that the strictness of the measures have eased compared with the again March to May period. However, we see that for example Israel has introduced another lockdown period, so this can overall we can say that the countries have removed all the restrictive measures, although they are now eased. But according to the again the virus cases, we can always go back to the spring period, although we don't put this assumption as in our baseline scenario, and consider that complete lockdown chances are for now are low. Well, the recovery in the Middle East and Turkey region is very correlated with the rest of the world. Now, against what Carlos did with the GDP forecast in European region, in this part of the world, we have a little bit deepened our contraction forecast because of the high volatility in oil prices and the negative impacts of the lockdowns in those countries. So we expect a general contraction of GDP between 19 to 1.1% for this year, and a recovery between 1 to 5% next year. Well, the recovery outlook for next year remains quite sluggish due to the continuous oil dependence of those countries and the still low level of oil prices, and of course the lack of tourism revenues. On the other hand, oil importers such as Jordan and Lebanon, they deal with other issues such as political and economic instabilities, which also weigh on the recovery process of those countries. Well, regarding to the PMI data, actually, we noticed that the activity across the region gains momentum, but it is still quite vulnerable. After falling in April, the PMI data suggests that the business activity has started to recover and the operating conditions have improved. It has a similar path with the lockdown measures. Actually, after the easing of measures, activity has started to bounce back, and this is also in line with the global PMIs. Without going too much into the details, we can say that for example, in the United Arab Emirates, employment component is still weak as companies reduce headcounts due to the downward pressures on profit margins. And panelists see they feel optimistic about the future output, but most of them are quite concerned about the economic recovery. In Saudi Arabia, the employment section again is under pressure, and new orders but increased, which is a positive thing. Both input and output price growth slowed in September. Probably this is because the impact of the VAT, triple of the VAT tax, has been reflected in the August survey. But again, also in Saudi Arabia, we noticed that companies feel more optimistic than previously about their future output. So all in all, we can say that the conditions are mostly better now compared to the second quarter, but uncertainty weighs on the investments. So if we look to the second chart, we will notice that the subdued outlook for oil prices and production has direct and indirect impact on the growth performances. Well, of course, it has a direct impact because, for example, in Saudi Arabia, around 45% of GDP come from oil, but its indirect impact come through the fiscal spending from the government, as it reduces fiscal revenues and forces fiscal consolidation. So public investment cuts, we see tax hikes, or we see governments reducing or putting on hold subsidies for public wages. For example, in Saudi Arabia, regarding the preliminary budget statement, we saw that the country is now prepared for a spending cut by 7.5% in next year's budget. This shows us that the next year's strategy would be more focused on fiscal consolidation instead of more GDP, growth stimulus. So just a reminder, as Coface, we expect average oil price to stand at $45 per barrel this year and $50 for next year. As you can remember, OPEC plus countries have decided early in May that they would cut oil production by 10 million barrels per day until July, and then between July and December they would reduce by 8 million barrels per day, and then between January and April 2021 they would cut the oil production by 6 million barrels per day. So coupled with weak demand and decline in global trade volume, for example, in Saudi Arabia, oil exports declined by nearly 20% in the first quarter on an annual basis, and by around 60% in the second quarter, again on an annual basis. So we saw that the oil sector contracted by 5% in the first quarter from a year earlier, and 5.3% in the second quarter. So this has resulted in a contraction of 7% in the second quarter, after contracting by 1% in the first quarter. So in line with OPEC plus production cuts, we saw that Saudi Arabia oil production fell as low as to 7.5 million barrels per day in June, compared with the targets of 8.5 million barrels per day. And similarly, the United Arab Emirates production declined to 2.3 million barrels per day, compared with this country's target of 2.5 million barrels per day. So this also affects negatively the United Arab Emirates GDP. But this is not the only reason for this country, as the United Arab Emirates economy is the most diversified one across the region, and oil revenues accounts only for around 1/3 of the GDP and 30% of GDP. So the country suffers also the contraction in tourism revenues, in retail sector, and all the rest of the manufacturing sectors remained under stress. For example, Dubai Expo has been delayed to October 1st next year, and it will be held until March. However, it seems that the country will struggle to achieve the number of tourism arrivals targeted within this event, which was around 25 million people. So this, of course, in turn will impact consumer spending and then the business activity. Probably all these sectors, I mean the hospitality sector, the retail, and the services will continue to be affected negatively by the low level of tourism inflows unless there's a treatment for the virus. And under these circumstances, we notice that the most vulnerable countries are Oman and Bahrain, because as you can see in the second graph, they have the highest fiscal break-even oil price in the country. So they would need the spot oil prices to remain above $90 per barrel for Bahrain and around $80 per barrel for Oman in order to have an even budget balance, which is for now very difficult to attain. And because the balance sheets of those countries also as not strong as the rest of the country, in case of a renewed decline in oil prices, these two would be among the most vulnerable ones. And we can say that Oman will benefit from an easier OPEC plus cuts, production cuts, because as I said, it is gradually coming down. And well, but on Bahrain's side, the country has benefited, actually can benefit from, in exchange of an introduction of fiscal reforms, it can benefit from higher financial packages from its neighbors. But in a renewed decline in oil prices, this aid coming from the neighbors may stop, and this can again push this country in a difficult financial conditions. Well, coming to Israel, well, Israel is a small and very open economy, and it has a very strong economic and trade ties with the rest of the world. We saw that in the second quarter, the economy contracted very sharply. On a quarter basis, it contracted around 30%, but on an annual basis, it contracted around 7%. And the contraction was mostly due to the sharp decline in private consumption. So household spending, private spending declined by around 16%. But we saw that the recovery preliminary indicators actually suggest that there's a slight recovery in the third quarter indicators. For example, as you can see in the second graph, the Bank of Israel State of the Economy Index has started to recover, and it suggests that the economy stopped contracting. But this improving trend can be stalled or slowed down by the introduction of another round of lockdown. So it has introduced for now between September 17 and October 9, but it can be extended if necessary. And if this happens, this will, in the first place, hurt the retail sector, the services, but also it will also have a negative impact in the rest of the economy, as it will, in the first place, dampen the consumer spending. Well, coming to Turkey, Turkey has entered into a technical recession in the second quarter, as the economy contracted by 0.1% in the first quarter and 11% in the second quarter. Since then, the early indicators suggest that there is a V-shaped recovery in the economy, However, because of the sharp dependence on oil, imported intermediate goods to continue the business activity in the country, the weakness of the lira increases the inflation rate despite the contraction in the economy. So, as a result, Turkey finds itself in a situation that we call slumflation, where the GDP contracts, but the inflation increases despite the contraction in the demand conditions. Well, one of the reasons of the weakness of the lira comes from the central bank reserves vulnerability. Well, actually, in September, Turkish Central Bank has a total gold reserves equivalent of $43 billion, plus total international forex reserves of, again, equivalent of $43 billion. And the bank has a total international net reserves of $18 billion. However, if we move out from this sum, the swap positions, short-term swap positions of the bank, it shows that the net reserves excluding swaps has declined to around minus $18 billion. That's why actually the investors, international investors, find it a bit more risky to invest their money into the Turkish assets. A second reason of the Turkish lira weakness comes from the current account deficit. Right after the pandemic period, the government and the central bank eased the fiscal and the monetary policies like in the rest of the world, but it boosted too much the consumer loans, which jumped about 50% year on year. And as a result, Turkey's imports, the fall in Turkey's imports has been way more restricted compared with the decline in Turkey's exports. What I mean is that in January-August period, total exports declined by around 13%, while imports declined by around 2 to 3%. As a result, the current account deficit has started to widen again, fragilizing the Turkish lira. And because of this import dependence, the weakening of the lira results in a higher inflation in the country, which also deteriorates the inflation expectations. Then, if the pricing behavior is not improving, I mean, if the pricing behavior deteriorates in the country and people start expecting higher inflation rate because of the weaker lira, then the inflation gets sticky. So the price is increasing because the lira weakens, and then it becomes a self-fulfilling period, and because the prices continue to increase just because people expect a higher inflation. So we see that recently inflation expectations have started to increase. For, let's say, 12-month inflation expectations, we see that now market participants expect an inflation rate of around 10.5% compared with 8.9%, which is the central bank year-end target, and 5%, which is the medium-term inflation forecast. So, because of this increase in inflation expectations, the central bank recently hiked its rates by 200 basis points. And now the policy rate stands at 10.25%, but there is still a gap between the current annual inflation rate of 12% We saw some macroprudential moves coming from the banking watchdog and the government side that was mostly focusing on adjusting the tax implemented on the forex transactions. So it also helped the lira to recover and trim its losses partly, but still, because of the policy rate stands below the inflation rate, chances for the lira are high to fluctuate around the current level instead of posting some profits. So as long as the lira weakness continues, it can create downward pressures on the company's profit margins because of this dependence of the imported inputs of the companies. And also now the interest rates are getting higher because the central bank increased its average funding rate to around 11.5% from around 7.4% in mid-July. Companies now are facing double debt and cost burden, which means weaker lira plus higher interest rates. As a result, because of the weaker demand, this weighs on the profit margins of the companies. As a result, we stay cautious in sectors like energy, retail, chemicals, automotive across the region. So we are quite optimistic, and we think that risks are quite balanced in the pharmaceutical sector, but the rest, for example, for textile clothing and of course transportation remains in the higher risk level. For the textile sector, well, the most important producer is in the region is Turkey. Well, recently the opening of the European markets is a good news for textile exporters, but of course the balance sheet for some companies in this sector remains a bit weak because of their strategy of growing based on the banking loans. So again, for the ICT sector, we remain at high risk level, and for as I said, for the agri-food and for metals, the risks currently stay at high level, but according to the future developments, we can of course revise these risk levels. So I think this was the last slide of my presentation, and I thank you for your attention, and I will now leave the floor to Antonella.
Thank you. Thank you, Seltem. I hope all our guests enjoy the session. And thank you also to Marcos for this interesting and important update. Now it's time for your question that you can submit, as I told you before, via question windows. Okay, I will start with Marcos. Okay, as you told, we are now in the second wave. This is a reality. If there is a wave of insolvency in the next semester, what will that mean for the growth in 2001?
2021. Yes, very interesting question.
Yes, 2021.
Yeah. It's complicated because there are many dimensions to consider. So, on the one hand, our base expectation, and this is what you saw in the growth forecast, is that since 2020 was such a terrible year, assuming we progressively get the pandemic under control next year, whether that is by vaccine, whether that is by better non-medical measures, better treatment, etc. The assumption is that the pandemic situation will be better in 2021 than in 2020, and that therefore we can get to like normal economic activity conditions, and that therefore, given that the GDP in 2020 was so bad, in 2021 it can only like be like these plus 6% or plus 8% rebounds that we're forecasting. But something that remains to be seen, and it's something that we will not know until we know the size of this potential wave of bankruptcies, is exactly the temporary damage that will be done to the production apparatus. And if it is indeed the case that many companies go bust, we will see strong rises in unemployment that we haven't seen so far. We will see strong disruptions of business-to-business activity, because those companies that go bust, the companies that don't, will need to find new clients, maybe look to export markets, things like that. So these are all a number of reasons for which those effects of the wave of insolvencies could have second-order effects, and this is why the state is so laser focused on really trying to get as few insolvencies as possible, and ideally protect any company that would have been solvent, that would have been viable in the absence of a pandemic. So that is really a factor that we will have to look at very closely.
Thank you, Marcos. We switch now to Seltem. Seltem, a question for you. Do you anticipate a threat for a USD peg for Bahrain and Oman?
Well, no, not in the near future, because even though these countries have a higher debt burden compared with the rest of the GCC region, and a wider budget deficits, and despite the fact that their financials are quite low, well, I don't think that the financial problems that they will meet would be that difficult that they would need they will need to quit the currency peg. Actually, currency peg, in a sense, it provides a stability of in terms of monetary policies to those countries. However, of course, it leaves a lower reaction space in terms of, again, monetary policy. But I don't think that their financial problems would be so high that they would depeg. Contrary, actually, they would. There can be always some financial assistance coming from their GCC neighbors. Plus, as we expect a slight increase in oil prices next year, and a slight and gradual recovery in the world trade volumes, these countries will be in a situation with better growth performance that will allow them to reduce their liquidity and debt problems.
Thank you, Seltem. I switch again now to Marcos. Marcos, we have the name zombies cloned by Japanese. May the public government aid create a problem of zombies companies in Italy and Spain in the coming months? What do you think?
Yes, so excellent question, very related to what we were speaking of earlier. This is kind of like the contrary risk. So the risk that we were talking about earlier is the risk that not enough companies will be saved, and that will have second-order effects. This, on the contrary, is the risk in some way that too many companies will be saved, and it's a risk that might seem a little bit severe, when you talk about it that way. We must always forget that behind all these companies, there are always real human beings, real workers, small business owners. But yet we have to remember that these are countries that have structural problems in terms of growth, in terms of potential growth, and that phenomena of the zombie company. By this we mean companies that are insolvent in all but name, that maybe are being that have very structurally low profitability, structurally high indebtedness, and that maybe are just hanging by a thread because banks keep refinancing them, or in this case because of government aid. And in principle, this is something that the governments are watching out for. They make it very clear that we want, as much as possible, our help to be targeted to companies that had good financial health, especially when it comes to loan guarantees. The problem is that when the government attributes these aids, they are not only making a reflection on pre-existing or present viability, but they are making a judgment on future viability. And that is a difficult judgment to make only technically, but also a judgment that has political considerations and that might have perverse incentives. Again, a company that goes bankrupt is something that can have very bad electoral consequences. So if we want to think about like a high-profile case, we can only think about all these very long situation in the metal sector in Italy going on in Taranto. So if this is something widespread, the problem here is that the aggregate profitability, the aggregate competitiveness of the country does not improve. And you find yourself in that situation that you saw in Italy in many years before this crisis, where it's not catastrophic, but it's stagnant. Living standards stagnate, competitivity of firms stagnate, and it leads to a very vulnerable situation going into a crisis. So this is definitely a risk. Now, an element of positivity here is that we have been talking about this help coming from the European Union, these very significant funds from the European Rescue Fund, of which Italy and Spain will be very large beneficiaries. And to my understanding, there is quite a bit of due diligence being made so that these funds are invested in things that will improve economic competitiveness and transition to a more sustainable, more digitally savvy economy. It remains to be seen whether quantitatively which effect will be prevailing if what is invested into sustainability and digital economy quantitatively is larger than this effect of zombie companies dragging down, or the effect of many zombie companies disappearing in the wave of insolvencies. Again, we will only know this after the fact.
Thank you. Seltem, we go for you. One on China. Can China's recovery have any positive impact on oil prices and GCC final sales? So the relation between two. Thank you.
Yeah, thank you, Antonella. Yes, of course, increase in Chinese oil imports will have a positive impact on the oil prices, but alone it will not be enough unless there is no recovery in the aviation sector and the travel businesses, which is the largest and the biggest clients of the oil products. A sustainable recovery in oil prices seem a bit difficult. Of course, if this happens, it will have a positive impact on the GCC countries because around 15% of their whole exports are addressed to China. So alone itself, an increase in oil imports of China will be necessary, but not enough to have a sustainable increase in oil prices.
Thank you. One last question for Marcos. What is the vision in Europe of Spanish government? Thank you.
Well, it's a question that can be interpreted in many number of ways.
Yes.
I could interpret it as, if I interpret it as what is the role that Spain has played in these latest, in at the level of European governance. So what's been happening in the executive of the European Union over the last year, these negotiations of the Eurogroup, of the European Council, what happened, what was finally agreed in terms of these recovery funds, then the Spanish government, along with the Italian government, along crucially with France and now Germany, has had an important role in being this voice for at least going in the direction of European federalism, or at least sticking together in times of crisis. I suppose that the role of the Spanish executive, being an important economy, being a very progressive government, a very Euro favorable government, had a role in fostering this. If I interpret that question more like domestically, if I interpret the question in terms of I don't know how the government has been handling the pandemic, how the government has been handling economic policy more broadly. I think that there is a vision that Spain had been doing things, I wouldn't say ideally, but rather well in the last few years after the last crisis, implementing reforms that were fostered, that were recommended by the European Union, labor reforms, things like this. Developing competitive industries like their nascent renewable energy industry, which has a lot of future. But and of course, I don't know what the European leaders think, and they don't tend to pronounce themselves with regards to domestic policy. But I assume that they must be worried about what's going on with political fragmentation in Spain, whether that is on the traditional left-right divide, or on the relationship between the central government, the autonomous governments, and what's been going on with the independence movements. I suspect that this is a source for worry, and we'll have to see. Europe definitely has an interest in there being a strong unified voice in Spain when it comes to European matters.
Thank you, Marcos. Last question also for Seltem. Another question on the link between countries, and this time is the link between Europe and Turkey. How strong are the economic links? And related to this, can Turkey's problems spread to European economic and financial system in some way?
Well, European countries and the European Union as a bloc is the largest trading partner of Turkey. So it attracts around half of the Turkish export goods. So in this sense, it's an important trading partner, and most of the financial inflows into Turkey come from this part of this world, and they have important investments in the Turkish business sector, in the banking sector. But I don't think that Turkey will find itself in a financial difficulty that would spread across the European countries. Well, recently, despite the Turkish lira's weakness, where early this week the government has issued a 5-year Euro bond, and there was the total bids have tripled of the amount that the government would like to borrow from the market. So although some economic fundamentals of the Turkish economy have now a bit weakened compared with the previous years, well, chances for Turkey to fall into a financial crisis remain low for now under the current circumstances. That's why I consider that such a contagion effect for now is not on the agenda, but of course, if this happens, then of course the European countries would be affected.
Thank you very much. There are some other questions, but we will answer you by mail with the help of Seltem and Marcos. We are closing now the webinar. Thank you for your participation again. You will receive the presentation and the registration, the recorded version of the webinar. I thank you again all, and I say stay safe and goodbye. Goodbye.
Thank
you
you.
very
Bye-bye.
much. Bye.
Thank you.
You.